Today we're looking at the next market leaders on the ASX, as well as getting some trading lessons on why we can't just blindly hold the leading shares and sectors throughout market turmoil like we're seeing at the moment. The man guiding us through is Gary Glover from Novus Capital. Good morning, Gary. How are you?
Yeah, no, I'm good, Chris. How you going?
I'm all right. We will let the listeners know that you don't have your regular voice, as you have recovered from a cold over the weekend. Fortunately, not COVID. So that's why your voice is different. But you've also looked at the markets and pushed out your normal report. So thank you for doing that. You've pulled out a bit of education for us. So you're looking at why we're going to have to rotate through the shares. And that also fits into why you've picked some of the leading shares on your watch list for the market. But before we get into those, the NASDAQ's off 31.5% from those November 21 highs. That's the turmoil that we're talking about. And in the process of rolling over, you had mapped out a target of 11,000 on the NASDAQ, which has just been met. The next target you plotted out was the high of 2020 before COVID. Is that still the next level you've got mapped on the chart for the NASDAQ?
Yeah, no, that's right, Chris. That's how basically minimum target's been sort of met here, around 11,000. That's essentially, if you measure the first leg down, project that off the first lower high there, the first decent one, that sort of gave us a minimum projection of around 11,000. So that's sort of what, your classic sort of ABC correction would be there. But I don't view this as being just a classic correction there, I think. I think this is sort of a larger decline coming here. So I do expect a much deeper move back here. Still believe that looking at the high from 2020, I view that as a minimum for mine. As much as we've got the measured move as a minimum, I still think we'll sort of see those levels there. So, we can't rule out something bigger here, but I think that's probably the best. From a technical perspective here, that's the target to keep an eye on the most here. So that's the one that's the most obvious. Matches up with all the cycles, as well. So in terms of projecting the first leg down, that gives us a decent sort of move back here as well. So just I just think that is the preferred target here, as much as we have met the first leg down. What are we? We're down 31.5% on the NASDAQ, but I still think probably looking at 40 to 45% is sort of where we're this sort of size move is going to be, I think.
And that 45%, you've got a 7,000 area highlighted on the chart, which is around the lows that we saw in the depths of COVID. Is that the kind of region that you're looking at, the 40-45% retracement?
I think the 10,000 will probably end up, getting pretty close to the 40% there. That'll be around that mark there. I just can't rule out something towards the sort of 7,500 there. Just because this has been such a really like a long-term bull market and quite an advanced sort of stage market as well. And we've had sort of 3 ascending trend lines as well. So oftentimes when you've got a market which has been running for multiple years and each level sort of advancing at a faster rate, they often come back to where the last rally started from. So over the years, I've seen some of these fastest moving markets there. They just got a habit of coming back to those levels. So I don't know. I'm not sure this one's going to do that. This one's sort of but I still think that the old high is the minimum target anyway, around that 10,000. That's a more logical sort of fit there. But yeah, definitely can't rule out something a bit deeper there. But yeah, I think give a modest 10,000. We'll see. Hopefully we'll be there by the end of June. That would be a good timing there. Good level to be at there. Get a bit of a bounce. Maybe come back and retest in October. October lows are pretty common in the second years, particularly every sort of 20 year as well. So every midterm year as well. So this is definitely October's a bit of a magnet for this year, but I think October might actually be a higher low, but we'll see. But yeah, I think at this stage, I think the market looks like it might have it's come down the bottom of the range here at the moment, so might attempt a bit of a rally, but I think you'll sort of see lower levels here in the coming sort of weeks.
Well, that's definitely the more volatile NASDAQ. if we move to the S&P 500, you had a target of 4,000. Now that's also been met, albeit possibly a little bit earlier. Has the timing and the speed at which the market has fallen, has that affected your next target and timeframes on the S&P, or is that very similar to what you just said on the NASDAQ?
Yeah, just similar to NASDAQ there, Chris. So basically just projecting the first leg down off the first lower high there gives us a bit of a target, just the classic sort of A equals C. But yeah, again, I still think that high of 2020 that's the key technical point here. So yeah, I'll be watching that level pretty closely there. So I still think this market can get back to around that 3,400. That's just the ideal downside target. That just makes more sense. Looking at the cycle we're in, look at the market we're in, looking at what's in front of us here as well for equity markets. So yeah, definite some ingredients there to push the market lower here with interest rates. Some pretty nasty interest rate hikes coming up. It's likely to scare the market. A few other things happening as well, which is still got supply chain issues, still got inflation. Interesting actually. I was watching an interesting Larry Williams video on the weekend that actually was talking about inflation there. And historically, actually, markets like the inflationary cycle isn't always negative for equities markets, but when inflation peaks and then starts to decline there, that's normally when markets tend to find their lows. So it's sort of not, we don't need to sort of see inflation come all the way back down again. We just need to see inflation start to ease. So, if you think, obviously, China's been locked down for, last few months, so supply chain issues are going to persist. The oil price is still pretty high here. It looks like it's going to persist. So I think I haven't seen anything, none of the inflationary pressures have eased here. If anything, with wages and everything else, they're probably going to go slightly higher here for the next quarter. But maybe the third quarter of the year, you might start seeing some easing there. So if we see the oil price start to cool off, we start to see supply chain issues start to be resolved a little bit. Those are the signs will probably be near a market low based on what Larry was saying was historical stuff. It's pretty interesting actually. So, but just so historically market lows come in when these inflationary peaks start to just turn down. So I can't see the peak here yet. I can't see any relief there yet. So I think the market's going to go lower. But once we start to see some of those inflationary pressures start to ease off there, that'll be the sign there that equities maybe can bounce and recover.
Well, that'd be great for the US as well as the Australian market. We've each got our own macro specifics. But the Australian market, as you pointed out many months ago, would most likely be more resilient should the market fall. It's still within that tighter range, but you've noted in this week's report that the volumes are climbing. Are we heading towards a marginal new low that you flagged a couple of weeks? Is that still what you're tracking for?
Can't see another outcome there, actually, Chris, to answer. So it's this is a chart which we highlighted for 6 to 12 months ago as sort of it could mimic 2002. It could be very similar, and it's been more than similar. It's almost been identical. I mean, the percentage moves, the declines have been identical. The broadening nature, marginal new highs, marginal new lows have been identical. It's been very, very similar here. And just look at the price action too. We saw that rally here on that last rally. See how the volume just really, really lightened up as we got higher. Went to marginal new low and lighter volume, and then we turned down and we saw some selling volume come in. And we've seen the selling volume actually come in on the way down a few times here now. It's actually been probably a bit more aggressive on the downside, which is unusual because it's normally the other way around. So yeah, we've seen heavy volume here on the way down. So can't see any other outcome but a marginal new low here around 6,700. Potentially might even overshoot and go a little bit lower. So maybe you'll see a little few counter moves here. I know we're sort of bouncing off a bit of a range here now, so maybe we can go sideways for a week or two. But I think ultimately here we're going to go back to retest that low and go ultimately just sort of lower there. but I don't think it's going to overshoot by a massive amount. I think it'll just go marginally lower.
Well, in that marginal new low, we'll no doubt see some trading opportunities on the Aussie market, and we'll probably come into those before we get to the lessons of the past. Looking at the shortlist that you've surfaced for the companies possibly to be accumulating when we're rounding out that low, or to maybe be picking up when it starts rallying. You've picked up Polynovo, which has been on a significant downward movement for over a year now, but there's been a massive rally in the last week, which we can see on the weekly chart you've put in there. Why is this suddenly getting your attention?
It's getting my attention there, Chris, because at I guess the leadership group now, when we've seen things like the payment stocks, they've had a great run and then they've got murdered. And then we've just seen recently sort of lithium stocks have been running for a long, long time, and then they're starting to cool off quite big as well. So there's always a new leadership group that'll come through, and each new sort of, I guess after the bear market finishes, itself, there'll be a sector or there'll be a few sectors there which will show relative strength, will be stronger than all the other sectors, and starting to sort of come out of bases and stuff there. So we need to be, as this market comes down here, we don't want to be going into the old leadership groups, because the old leaders aren't going to lead the new market. It's going to be a new leadership group. That's what history sort of tells us. So just need to be sort of looking at what sectors might be coming out of the next sort of next decline. So I know we're probably 3 months away from that decline, but maybe shorter, who knows? But yeah, we're still a long way away. But you just might start to see a few stocks start to build a bit of a base here anyway. So I just noticed, like Polynovo, I just noticed a few of the healthcare stocks. I mean, you've got to think about those. Those really have been hampered by COVID disruption. So like a lot of the health, I know some healthcare companies have actually been advantaged by all the testing and stuff there, but a lot of them, I think something like Ramsay, for example, there hasn't been able to, all its elective surgery has all been knocked back. So it's, have 2 years of sort of built up demand for, so those healthcare companies have been disrupted quite a bit, but there'll be pent up demand behind them. And there'll be quite a few other healthcare and biotechs that have been disrupted quite considerably by the COVID here. And this going back into more normal healthcare operations and being able to do normal operations will be probably quite positive for them. So to me, it's a sector which makes sense to me, but then they've had pretty big declines as well. But if they can start to show some relative strength there, that's a sector which could potentially lead us out of the next market. So that's why I'm just sort of thinking, okay, when I start to see price action here, we saw good volume at the last low. We saw a bit of a pullback on light volume. We saw a nice volume push here, nice impulsive move. So okay, that's kind of bullish price action, taking a swing high out as well. So a few little signs of positivity there. So I think you probably want to see a bit of a basing pattern here first, a bit of a building pattern, but definitely a sector I'll be watching pretty closely there. That price action is telling me we should be watching it closely as well, because it's already, considering we're sort of had a pretty bleak negative market there, this is showing a bit of strength here in the face of that negativity.
So that's that relative strength against the market. The whole healthcare space is looking as if it's not falling as much, and you've highlighted Polynovo as one that's actually put some good runs on the board, big volume breakout, broken over a swing high, all while the market's actually been on the nose and quite terrible. So
yeah,
is that sort of the early characteristics that you've seen?
I think so. There, I think that bid for Ramsay at $88, that sort of tells you that what private equity are sort of thinking with some of these healthcare. So and I saw Polynovo, I think if I'm not mistaken, I'm pretty sure directors have been buying up pretty aggressively too in the last few weeks. So just some pretty good signs there. So it's definitely a sector we should be keeping an eye on, looking at a bit closer. And because the fundamentals make sense. They've been disrupted for 2 years, so they haven't been able to do normal operations. So if hopefully the worst is behind us in COVID, then and we get back to normal sort of operations there, then the healthcare and biotech could be a sector which could be a beneficiary as well.
Well, that's Polynovo, and you've also mentioned in the last couple of weeks that you're keeping an eye on gold companies. So you've highlighted in this week's report Evolution Mining EVN, and then also Star NST. What's happening on those charts? Like those drops look pretty significant on EVN. So how is it that this is catching your eye?
Yeah, so all these stocks look pretty similar, Chris, actually. So the gold sector has been, they had that low in September, had a bit of a, sharp bounce, come back and made a high low in January, and then had a really sharp bounce. What caught my eye was that first high low. The volume following that was pretty strong, pretty robust. So we actually got some really strong volume on that rally, and that's what really caught my eye. Okay, that's the first time I've seen some pretty, what I call a change in character. And but sometimes these basing patterns can take a while. So it's come all the way back down here. The selling was a little bit higher than I'd like, but when you put it, I guess when you overlay it next to the volume on the way up, it's quite a bit lighter. So it's in context to what it's previously traded as well. So, but could be a key point here, really. Oftentimes, if we're basing there, we'll keep finding sort of high lows. So the reason I really like it, Chris, is the risk reward here. So if we're sort of using the last stop as our stop, really tight there, we're talking 5-10 cents, or maybe 10 or 15 cents maximum. And then if we get the upside, if this is a basing pattern going to go to a new high, then you're talking about $1.50 upside here. So risking 10 cents to make $1.50, 15 to 1 risk reward. Yeah, it's you don't need to risk too much to have a nice win there. So just thought a little bit of risk here. Obviously this not perfect setup, probably a little bit wider in its orientation from most basing patterns, but commodities often do this, and commodities definitely been the sector to be that's been on fire recently. So definitely a sector which can definitely catch fire as well. And so I just think this looks interesting here. I'd be using the last low as my stop, something maybe just a little bit below that. And just great risk reward here. So if you're wrong, you will probably know straight away, probably know in the next week. But yeah, for me, it's one of those things. If I'm going to look at this, I'd probably start with a bit of a small position, and then once I start to sort of see it hold and then turn up, then I can probably add to it. And if I'm wrong, I've only risked a small amount, and I've only had a small position size on, and I'm risking a tiny position, on my stop as well for a great risk reward. So that's really why it's taken my fancy. I'd say it's, from a probability point of view, it's not. I wouldn't say it's the strongest sort of pattern I've seen, but I know the characteristics. Just look at the characteristics of that chart there. Non-star, look how volatile. Even the way up there, it's up and down, up and down. So, just the risk reward is the thing really catching my eye there.
Okay, so that's some of the gold. I think you said that's across the theme. So they're sort of working together. They're showing that similar behaviour, showing higher lows, which probably takes us to the market lessons that you've highlighted this week. You've brought out some of the old favourites. So those who were trading, short-term trading, swing positions, EML payments, was one of the ones in that group that was traded heavily, and a lot of good money was made, but it's come off a lot. What are we learning from EML today?
I think the biggest lesson here, Chris, is that it's okay, when you're trading these leading sectors, so it's obviously the stocks that have got momentum behind them. So sometimes they've got okay fundamentals, sometimes they're not okay. Sometimes they're going to be the second or third leader in the sector, things like that. But those sort of really what they call leading stocks that have the really big price moves, they tend to have once the move's done, they can have really big declines as well. And oftentimes people are the retail traders are often sort of buying the dip on these trades, and then trying to average down, and then they typically get caught out here. So our retail public is often late, coming in too late to these hotter sectors, coming in towards the end, and they're buying the dips when you can see here when it starts to dip, the dips can be just as enormous as the rallies there. And that's the thing you've really got to take into, you've got to really understand and learn from the past here. Pretty interesting pattern here if you look at the EML payments there, the fact that it had that massive drop there into the April 2020 and then rebounded all the way back, went to a marginal new high. So I often talk about false breaks and marginal new highs, marginal new lows. I mean, this is a classic one here. It kind of reminds me of the S&P500 in 2007 went to marginal new high, and then the theory suggests that we'll go back and retest the low, which at that stage was 120. So when you're up at $6.60, it started to fail here. If I'd said to you, hey, look, this pattern here has failed, the technicals suggest that it could come back and retest the low, you'd probably think I was crazy, but maybe 2 or 3 weeks later, you might be thinking, oh, shit, you're half a chance. But now we're almost there. So there's just this interesting sort of theory here is worth highlighting, but probably more important for the listeners there is that just it's okay to trade these leading stocks, and when they're trading, they're in play, but you always have to run a stop on these things. You just, whether you're back at the 50 or back at the 30-day or 20-day, whatever you're using, it should be, as it gets steeper and steeper, you probably should be tightening that stop up, but you must run a stop here on these leading stocks, because once they're done, what follows can be pretty nasty. So you don't want to be holding on blindly, watching these declines here. Unfortunately, a lot of our public get, want to buy these leading stocks after they get, murdered, and it's only really a quarter. It's usually only sort of a small murder where the whole thing is. Typically these have it's usually a large murder takes place. So. The 50-80 rule is the classic rule there. So 80% of those leading stocks will come off 50% in value, and often case around 50% of them will come off 80%. So people underestimate the size of these declines for these leading stocks. They come off big. So got to keep that in mind. So it's okay to trade these leading stocks, the ones that are on fire, the ones that are really firing up here, but you've got to understand what follows these massive moves as well.
So EML is a good example, and a more recent one showing the chart and the enthusiasm in the chart in the more recent times since COVID lockdown, lithium and graphite, which we polled the audience just last week and found that more than half the audience was still bullish, long-term thematics, long-term fundamentals on lithium. So this could be a contentious one to raise here, but Novonix is a chart that you've pulled out. You've got a fair few arrows in here pointing out possibly opportunity breaking breakouts, and in your list of ones to learn from former leaders. So can you talk us through the rally and then what's happened after the rally of Novonix?
Yeah, I mean, it's a massive move there for the last couple of years there. We got gone from 13 cents to $12.47. Geez, for some guys trading this would have made some pretty big money here if they'd been able to hold through the whole cycle there, but you still have to exit at some point here, and then you can always come back in again. That's the thing with the leading stocks. If they do call off, you just need to wait for a consolidation, and then once they push through, swing high consolidation point, you can always come back in. But when it's all said and done, when these rallies get vertical and get pretty nasty, this is the point where that's sort of what $12. That's the point where basically everyone's convinced that lithium's the new frontier, and this is going to be a trend for the next 5-10 years. And anyone who invests in lithium will never lose money. That's the thought process when you're buying them at $12 there. But that's that's usually sort of oftentimes when there's sort of momentum so high and so big, and everyone comes in sort of too late here. So people still got the view that lithium's away, but we've seen there's new technologies around the corner. Lithium's not as rare as it. A lot of people can get there. Obviously, the commodity price can move. So there's just a lot of risk in the market people underestimate. So, but they also underestimate these leading stocks as well. The stocks that really have these phenomenal gains, the ones that the leading sectors and have the leading sort of moves, these sort of massive moves, they always have a massive reaction as well. That just learn that 50-80 rule. I cannot sort of stress that rule enough. That's sort of one of the think Mark Minervini or William O'Neill sort of, it's one of their sort of rules. I know Minervini speaks about it all the time, but it's so, such an important rule, and so true. And I mean, even I was reading something the other day about the 70s and inflationary period, and I think at that stage, McDonald's and Coca-Cola, which was kind of like was kind of like the FANG of our period there. It was the FANG of their period. Yeah, those stocks had like 50, 60, 70, 80% corrections in the 70s market. They had mass, because obviously they were the leaders. They successful companies still are successful companies. They had these massive moves, and then massive declines follow those leading stocks. So even the best companies. I mean, Amazon lost bloody 94% of its value there in between 2000 and 2002. So the best stocks on the planet can still have these massive corrections. So you must have it's okay to trade the momentum. You must have a stop in place. At the very least, I'd be using a 50-day moving average. That would be that's my last stop level. Nothing good happens under the 50-day moving average. So that's something that's been ringing through my ears for the last year. And and I haven't seen anything to change that view. If anything's more supportive, but if your stock goes for the 50-day moving average, I think you're in trouble. And that's but you really should be probably tightening up before that. If they're really getting vertical like that, you should be sort of tightening up there. But just need to put in context, just a bit of a lesson for everyone that we're all looking to sort of trade these big winners, but we must have some risk management. We must run a stop here. That's imperative.
Nothing good happens under the 50-day moving average. I like that as an action to keep throwing back over when you're looking at a trade. What's happening here?
Yeah, I learned that a year ago, and it stuck in my head. I wrote it down, and it just keeps hitting home week after week. It's actually it's an amazing for these leading stocks. It's really important.
There's some good insights on the leading stocks. What to look for in the current leaders that are getting punished as the market's falling, those high growth ones getting hit hard, and then also what to look for in the new leaders as they come through, because as the leaders in the whole market getting pushed under that 50-day moving average, you're sitting there working through the whole list, looking for the next leaders that are possibly at or above the 50-day moving average. Is that kind of a cycle that you're looking for?
That's right. Yeah, we all want to be sort of catching the next sort of leadership group, the big movers, the big winners. So where they're going to come from. And so if you sort of study bear markets in the past, that's sort of what, they start to, the strongest sort of stocks, as the bear market's finding its low, the leading stocks are actually making sort of higher lows and have been absorbing the pain there and actually been building. And they're the ones that actually the strongest. People end up trying to buy the weaker stocks because they think they'll get the biggest bounce back. But the reality is the stocks that hold up the greatest, show the greatest strength in the face of the nastiest bear markets, they're the ones that go on and have the biggest gains.
Well, that's what we'll definitely be looking for, and we'll be coming back to your weekly report to get those insights. So thank you again, Gary Glover from Novus Capital.
Thanks, Chris.